Utilizing a bank account is great for internal controls of a business. Banks help safeguard cash and provide detailed records of cash transactions, and only certain authorized personnel have access to the bank account. If somebody doesn't have access to the account or isn't pre-approved to access the account, then they're locked out of that bank account. And so it helps limit who has access to the cash in every single business. Every time a deposit is made into the bank account, the bank will issue what's called a deposit ticket, or sometimes it's called a deposit slip, which lists items such as currency, coins, and checks that are deposited along with the amount. So here's a good example of a deposit slip. It's the date that the deposit was made is on this slip, and then it lists out what exactly was deposited. So we had currency of $35, that would be cash, the dollar bills. There's coins for $1.50. And then here's detail from the other side, which is all of the checks that were listed for $203.50. And so here's the back side of this, and here's the check numbers. Here's the dollars and the pennies on each check. So a deposit slip or a deposit ticket itemizes every item that went into each deposit that was made into the bank account. And now when it comes to taking money out of the bank account, there's the checks that, again, an authorized personnel is only able to write a check out of a bank account. And now it's important to know that when a check is written, it is an authorization of the owner of that bank account to, they're authorizing the bank to make a payment to somebody else. And so when we look at this check, we have our date up here. And this is a check that I'm sure a lot of you are used to seeing. Here's the date up here. Here's the maker. That is the owner of the bank account. That is the company that has this bank account and uses for all of their money. There's the payee, the person that is getting paid, and then the payer. So the payer is going to be the financial institution or the bank that is going to be sending the cash to the payee. And on a check, there's also an optional remittance advice, and that is a detail for what exactly is getting paid. So you can see here, here's the date, and then here's a description of what is getting paid. And on here, it's important to note that there's an invoice number, and then the gross amount. So if multiple invoices are getting paid, if we get 5 or 6 invoices a month from a certain company, but we just pay them once a month, and we just say, here's all the invoices we got for the month of October, and we're just going to pay it all on one check. That way, this remittance advice is going to go and list every single invoice that is being paid. So here's the invoice number, here's the amount, here's the net amount of that invoice. And so the total here, down here in this remittance advice, is going to total to the total amount that's being paid on this check. And so that's the importance of a remittance advice. It's really utilized by companies when they're paying invoices. It helps itemize what is being paid, so the company that issued the invoice knows how to apply it. We are paying these invoices, but we're not paying these ones quite yet. So that is a very important key to these checks, and that's an optional remittance advice is an optional portion of the check. Banks also allow for electronic fund transfers. This is completely electronic, where it's just movement of money from one account to the other. It works very similar to a check, except there is no physical check. It is all done digitally. Every month, the bank, the financial institution or the bank will issue a bank statement, and that is very important for a business, because that will go and tell you every transaction that hit the bank account, whether it's an in or an out. It totals all of the bank activity and it's typically by month, but I've seen them by quarter, where it's all of the bank activity that happened in that time period. And so on a bank statement, it always starts with, here's the beginning period bank balance. And so that should tie to the ending balance on your prior statement, and that's going to be your beginning balance on this statement. It's going to list out all of the withdrawals and other decreases to the account, all of the deposits and other increases to the account, and then the ending balance on the account for that period. So Here we can see just a little mock bank statement. It's First National Bank. Here's the company that we're looking at that owns the bank account. On October 1st, here's our beginning balance. And then here's our cash deposits, which this one happens to tie to this. Oh, no, not the check. Here we have a net deposit of $240. So we can see that. We can see that here. And so the bank account will list all of the deposits made throughout the month. It'll list all of the checks throughout the month. Here's a printing charge. So it's not necessarily a check, but it's still money that came out of the account. It was a charge on the account. So a bank statement will go through and it will list all of the withdrawals and other decreases, as well as the deposits and other increases. So the other deductions or other decreases to the bank account will typically include bank fees. It'll include check deposits that are uncollectible. It'll do corrections of previous errors that were discovered, and withdrawals from ATM machines. So those are just some of the other deductions in the bank account. And so when it comes to deposits, it's the usual deposits, but then there'll be interest that will sometimes hit the bank account. And sometimes the bank error that gets discovered is it will need to increase the cash. So these here are very good controls that are able to be utilized